Hello, my name is Kurt, I'm a value investor, and this is our very first video on our journey in the Value Investing $1 Million Challenge. I have done a little bit of research, I have picked some stocks, and I have loaded $2,000 into my brokerage account, and I have bought 4 stocks, and we're going to go over them today. Now, the ground rules of this challenge is that I'm starting with the $2,000 initial deposit, and then every 2 weeks, I'm going to deposit $200 more. I'm going to buy stocks that are extremely undervalued and hold them until they reach their intrinsic fair value, and then I'll sell them and buy more stocks that at that point are intrinsically undervalued. The stocks I'm going to be buying are stocks that are extremely undervalued based on their underlying fundamentals and financials of the company. That is starting with their balance sheet, that is going all the way to their cash flow statement based on my prediction of their future free cash flow discounted appropriately. It's based on their earnings and their revenue. It's based on their brand and how well I think their company is run based on what I know about the company. For most of these companies, I'll have looked at their annual reports. I will understand the business just enough to know that these businesses are good businesses to own over the next few years. So if you would like to join me on this $1 Million Challenge, go ahead and open up a brokerage account. If you're looking for a broker to start this challenge on, maybe you already have a broker, but you want to start a separate account just to follow along with my journey, then I have a link down in the description for Interactive Brokers, a referral link where you can get free stocks. Now that referral link is temporary, so I can't guarantee it for everyone that's watching this video, but it doesn't matter what brokerage you use. You can use Moomoo, Interactive Brokers, Robinhood, Webull, or any platform where you get near zero trading commissions, and I welcome you on this journey with me. Let's learn about value investing and let's make $1 million investing in the stock market together. Now, this is going to take a lot of patience. It's going to take a lot of perseverance. This is not getting rich quickly. This is getting rich smartly, and this is getting rich patiently. But the tools and techniques we're going to use are going to be beneficial no matter how much money you have available to contribute. And I guarantee you, if you save consistently, use these principles wisely, then you will beat the market and make a decent return on your money over time, the same way many investors have made billions over their lifetime, such as Warren Buffett and such as Mohnish Pabrai, Bill Ackman. All of these investors used value investing principles, finding the intrinsic value of a company and buying companies whose price is severely underneath their intrinsic fair value. I'm going to go into the Moomoo trading platform to show you the stocks that I bought, the balance that I have at the moment, which is only just over $2,000, and some of the tools on Moomoo that I think are really helpful. Over the next few videos, I'm going to show you all sorts of things like how to actually determine the fair value of a stock, the intrinsic value of a company and its stock. And I'm going to do a video where I just cover discounted cash flow analysis. I can't do all that in this video, so this is just an introduction to show you the first 4 stocks I bought, to show you where we're at now, and then be prepared over the coming weeks to learn all these techniques about how to value a company, and let's start digging into some companies, turning over stones and finding really great companies. And after I show you my Moomoo account and a couple cool things, I'm going to switch over to a spreadsheet where I'm going to be tracking every single trade, every single dollar I put into my brokerage account, every trade that I make, every fee that's charged. I'm going to document every penny to show the actual progress, the net asset value of my account. So let's get into it. Okay, well, here is the Moomoo platform, and this is my trading account for this challenge. Now, I'm starting in Moomoo, but that doesn't mean I'm going to keep this portfolio in Moomoo for the entire duration. Remember, to become a millionaire, this is going to take probably 10 to 15 years, if my math is correct, and of course, depending on how well we do. And so we could be switching this portfolio over to different brokerage accounts at different times. The reason I'm starting in Moomoo is that Moomoo has some really great tools for finding really good companies. And I'm going to show you guys that in case you're interested in using Moomoo. But I also got a lot of free stocks for signing up for Moomoo. So one of the reasons you're seeing that this portfolio balance is above $2,000 is partially because I bought these stocks a couple days ago. And so we already have some gains on the $2,000 I put in, but also we had a few stocks that were given to me just for free for signing up. I'll show you guys that in a spreadsheet that I have that I'm documenting everything about this challenge. I'll show you exactly the stocks that were given to me, how much they were. I sold them immediately as soon as I could, and therefore I started with a balance a little bit higher than $2,000 even. But as you can see, we're pretty much there. We're at our $2,000 initial investment. I have not put in the other $200. I'm going to do that 2 weeks from now. So 2 weeks from today, I'm going to release another video, and I'm going to have $200 more cost basis deposited into this account out of my own savings and earnings. And this is my own real money. This is not a paper trading account. Now, the 4 stocks that I've bought, you can see right down here: Foot Locker, Ternium, Brazil Agro, and Vista Outdoor. These are the 4 stocks that I am starting this challenge with, and we'll talk briefly about why I chose these stocks. As you know, over the last 2 weeks, I've been doing a lot of research. I've been looking at many different stocks. I have a pretty decent list of stocks that I have valuated in my own time previously. I've released 2 discounted cash flow analysis videos on this channel, and I'm going to continue to do that. And so right now you can see that I have a pretty even split between these 4 stocks in the portfolio. I really didn't distinguish between them as far as portfolio weighting. I bought 17 shares of Foot Locker, 15 shares of Ternium, 104 shares of Brazil Agro, and 17 shares of Vista Outdoor. And you can see at what price I bought them. And you can see my current profit and loss for these stocks and my profit and loss on the day. Of course, the market has been up broadly. Since I bought these stocks a couple of days ago. And so I'm not shocked to see them up. The daily and the weekly and the monthly change in the price of these stocks does not really concern me. I have very clear price targets that are way above the current price for all of these companies. And so if they go up a little bit, or even a decent amount over a few days, I am not really bothered by that. If they go down, I don't care. If they go up, I don't care. I am holding these stocks for probably a long time for them to realize their true intrinsic fair value. Now, I want to show you a tool that I used, at least maybe not to find any of these companies in particular, but that I've been using to try to find companies that are really undervalued. And the one metric that is really easy to use is price to earnings ratio. Obviously, we want a company whose earnings are really high relative to their current price, the price we can buy them for right now in the market. And Moomoo has a great tool for this. It's basically a stock screener. And to do that, I just go to this Explore tab in their desktop tool here, in their desktop platform. And what I've done is I've just put a PE static and trailing 12-month filter on this to show stocks that have PE ratios less than 5, from 0 to 5. So they're profitable companies over the last year, and their price to earnings ratio is less than 5. 5 is a great price to earnings ratio threshold because typically fair value companies have price to earnings ratios closer to 10 or 15, or even higher, depending on the growth of the company. Obviously, there's so many factors at play, and I do a deep discounted cash flow analysis on every company I end up buying. So this is just a screener to kind of point out something that we might not be aware of. Now, the other criteria I did put in here is price to booked ratio, which if you can see down here, I put from 0 to 1.5. So not only are these companies at low PEs, but every company shown here has positive assets. In other words, they have assets greater than the liabilities. And also, if you do a ratio between the book value of the company and the price of the company, it's not really high. It's not like I'm paying 3 times the price for the current assets minus liabilities. So a good rule of thumb is, or something to easily think about is, a price to booked ratio of 1 is a company who their entire market cap is equivalent to all the assets they have right now minus the liabilities they have right now. So if I had $100 in cash sitting in my bank account and I had $50 in debt, I could pay off the debt and my book value would be $50. Now, a price to book value of 1.5 is a really low threshold. Even a price to book value of 2, if it's a company that has profits, and especially if those profits are growing, that's a fantastic situation. So we want low price to book value ratio. We want low price to earnings ratio because we want that price to be really low. And so you flip the numerator and denominator there, and that's the kind of ratio we're looking at. Now, the first thing you're going to notice about a lot of these companies is that most of them fall within the same types of categories. Like we have credit services, credit services. A lot of these dashes are banks or financial institutions. You see China Construction Bank, you see Bank of China. We also have asset management, asset management, asset management, and credit services again, and mortgage finance, asset management, asset management. Okay, so a lot of these companies are repeating the same type. And that's what you're going to see when you do a screener like this, is that for whatever reason, there's one industry in the economy that there's a lot of trouble or a lot of caution about the future for that particular industry. And because of that, any stock that is within that industry is going to be sold a lot based on that fear or that worry. Now, the worry could be well-founded or not well-founded, and that's our judgment to go ahead and determine if all these asset management companies should actually have low PEs because their earnings might crash in the future, or if their earnings are going to continue to be fine and this is just irrational fear. Now, that takes a lot of wisdom and a lot of discernment. And so one thing that I like to do is to not play too much against the rest of the market. If the rest of the market is saying that credit services, asset management, and financial institutions there's a lot of worry about their future earning potential, I'm going to go ahead and trust the wisdom of the market a little bit more than myself in most cases. But I have to look at individual companies and say, is this individual company going to be resilient? Or is this individual company in trouble? So when we're looking at stock screeners, one thing I'm automatically looking for is things that pop out on this list of types of industries. So the first thing that pops out is apparel retail. So there's not a lot of apparel retail on this list. So it kind of makes you wonder, why is this one company popping up here instead of a lot of other companies that have the same industry type? Is the company itself really in bad trouble? Or is there something particular about this specific company that's feared and therefore it's being sold down, but the rest of its industry is looking fine? Well, that's the case for the company Foot Locker, which is one of the 4 stocks that I have bought. If you see right now, they have a price to earnings ratio of 3.6 or so. Now, I told you last time that I was looking for companies that had PE ratios less than 5, less than 4, even less than 3. And you can see if I sort by PE ratio, there are a good handful of companies that have PE ratios less than 3. Now, a couple weeks ago, stocks were in the tank a lot more, and so there was actually a lot more stocks on this list. There was a short gap that we had at the end of June and through July to buy some of these stocks. And as of right now, the market has really recovered. It has a big bounce, which I've chalked up to being a dead cat bounce or a bear market rally. So that's to be expected, but we're going to have plenty of opportunities to buy stocks that come down into this zone, into the 3 PE or less zone. But we have to look at these companies. So of course, we bought Foot Locker, and Foot Locker's trading at a 3.6 PE. Now let's just imagine that Foot Locker goes up back to let's say 10 price to earnings ratio. Now, I could see Foot Locker going to a 10 price to earnings ratio. I could see it going a little higher, but of course they have a lot of headwinds. They are in physical retail space, and physical retail space, malls, those all are being destroyed and eaten alive by Amazon and online shopping. But then you have to think about Foot Locker as a brand, and you have to think of their ownership and how they're being run. Is Foot Locker able to switch to online sales? Are they able to make a presence for themselves online and sell shoes to avid shoe customers who don't want to click through Amazon and look at all the cheap shoes or the shoes that are made off-brand? If people really want to get quality shoes and they don't want to look at specific store like Nike, but they want to look at a shoe source that has a collection of good brands of shoes, then Foot Locker is the place they want to go. And even if they don't want to go in person, does Foot Locker have an online store? Do they have a website where they're selling to customers? And I've done some research and I found out that Foot Locker is able to do all this. I mean, it might take some capital investment to get them into a really good position, but I think that this is very doable. And I could see Foot Locker, therefore, going back up at least something closer to 8 price to earnings ratio. And if they get to 10, look at what we've got. We've got a stock that's going to more than double in their price just if their earnings stay the same or their earnings grow at a predictable rate. But I think Foot Locker has a brand that is big enough to pull whatever resources that it needs into the space to get them back on track. Now, as I'm looking through, I do see a lot of mortgage finance, credit services, asset management, banks, and even residential construction, REIT Industrial, which is a real estate investment trust, anything residential construction or real estate or mortgage. I am not touching any of that stuff because to me, anything financial is kind of like toxic poison right now. We have very bad economy going for a long time, and you could see institutions really collapse. And what happens to the earnings of these companies is that they get written way down because you have tons of debt that gets written down and people default on debt. All of a sudden, overnight, bank just doesn't have revenue that it thought it would have. It doesn't have earnings that it thought it would have. So as I'm looking through this list, I'm looking for things that are popping out. One thing else that I've added to this list is return on equity consecutive 3 times annual is between 10% and 100%. So greater than 10% return on equity. If you've watched my other videos, you know that return on invested capital, return on equity, all these metrics I like to have companies that have greater than 10% return on equity. That shows me that they can take capital, they can take investment, they can deploy it. They have a business model where they can generate lots of return on that. Those companies are a lot more resilient in my eyes. And so that's another screen. Now, if we were to take that away, we might be seeing more companies here, but they might be lower quality. Now, I want to go back to my portfolio because the companies that are on my list are Ternium, Brazil Agro, and Vista Outdoor. And I just want to briefly explain what these companies do. I don't have time to go into an in-depth dive on all of their financials, on all of their discounted free cash flow analysis, but I'll be releasing those videos as standalone videos in the future. But Ternium is a South American company that's actually headquartered in Luxembourg, which is in Europe. So it actually classifies as a European company, but they make steel throughout the Americas. They make steel in South America, and they have some revenue from North America as well. But they're steel producers, they're steel manufacturers. So, of course, if we go into heavy recession, steel demand will collapse, and that's why the stock price has gone down a lot lately. But at the same time, you have inflationary pressures, and it's like a double-edged sword when it comes to commodities. They are very cyclical, and so yes, we might be sitting on this for a long time. But Ternium is strangely a pretty consistent company when it comes to earnings. So of course their earnings go up and down, but they don't spend tons of time in negative territory as far as profit. And I'll show all this on a standalone video for Ternium, but they're a steel maker. Now Brazil Agro, they develop and own agricultural properties in Brazil. Agricultural properties that do produce animal food products, but also they produce other farming products, agriculture, cotton, things of that nature. So they have a pretty diversified portfolio of properties, and they just sit on those properties. If they're developable, they'll take the profit from the yield of the farming that can be done on the land, and they'll sell the land later on. And Brazil Agro is one of the best companies that I've evaluated so far. They were in a huge cyclical pattern where they bottomed just a few weeks ago. And when the dollar was really strong, this company's price was really low in terms of dollars because they're located in Brazil. And so the relative value didn't translate well. But at the end of the day, I love companies like this. Anything that owns land, I mean, there is no more land that's being made, especially farmable land. And so if I just hold this a few years, this thing should balloon so much that it's going to give me a great return. But farms are great because they appreciate in value as population grows relative to land supply, but they also are productive in the meantime and they pay a great dividend. In fact, the dividend yield based on the price recently, which has been in a huge trough, and I think it will go up a decent amount in the coming months, the dividend yield based on the current price is above 10%. So if you buy this stock and just hold it for a long time, it should pay you some pretty good dividends. The last company is Vista Outdoors, and this is a conglomerate company that they just buy brands of outdoor equipment, retail outdoor gadgets and gizmos for people that either hunt or fish or do outdoor activities. One of the biggest things that Vista Outdoor does produce is ammunition for firearms, and I think it's mainly in the hunting space, but there has been a lot of political concern over firearms and firearm manufacturers. They own dozens of brands, and so pretty much anytime a new brand comes along, invents something, and it becomes big in the outdoor space, Vista Outdoor is going to come along and buy them. And that way, Vista Outdoor is able to push these brands and these products into stores around the country. So they don't need to spend on all the retail. They let the retailers do that, and they just collect on like royalties probably, or portions of sales. And I think that's a great business model for them. But I've also looked through their annual report, and they are very aggressive. They buy companies, and every time they see a good company, they go and buy it. So Vista Outdoors is trading at about a 3.6 or 3.7 price to earnings ratio right now. And I think their price to book value is about 1.3 or 1.4. So I think this is a fantastic company. So these are the companies I own. I'm going to switch over to the spreadsheet that I have where I evaluate companies. I'm going to show you each of these four and tell you what are my price targets for these companies. So this is my intrinsic fair value tracker for all companies. And right now it's sorted by their rating and their value. And the value column really corresponds to how many times more the intrinsic value of the company is relative to its current price. And you can see that in column M and column L. This is the value per share based on a 10 to 15% expected return, and column L is its current price. So we have companies like Boise Cascade, but here number 2 on my list is Ternium, which we own. And right now I'm displaying the dividend yield. The price to earnings ratio is 1.8 for Ternium, and the dividend yield is 5.1% based on their current price. I do have some pillars here which also tell me, okay, this company is a little bit more stable, they're a little bit more sturdy. If those pillars are closer to 8, and if the sub-pillars are closer to 21, those are the totals available. And right now, Ternium is trading at $35 per share, which is about where we bought it. Actually, we bought it, I think, closer to $34 per share. But right now, I have a value per share closer to $133. So this is a company where if it got to $100 per share, I would be looking at selling it. Even if it got over, let's say, $60 a share or $70 a share, I would at that point have doubled my money, and I would start to be looking and reevaluating this company to see if I could sell it. So that is really my target as of right now. And the closer it gets to $133 per share, $130 per share, the closer I'm going to start looking at it. The next company on our list is Brazil Agro. The pillars are 6 out of 8 and 14 out of 21. The P/E ratio, if you actually look at this company, is close to 3.5 or 4 right now. And Brazil Agro is trading at about $5 a share. I bought it under $5 a share. Now it's above $5 a share. And the intrinsic fair value for this company is $14 per share. So we have about tripling to do before we get to fair value. That would be a 200% return if it were to get to $15 per share. So let's look for this one to get to about $10 per share before we look at selling it. Although in recent cycles, it has swung up to $8 per share, I think a little bit above $8 per share. So that would be a good time for us to look and evaluate and see if there's something else that we can sell LND for and buy. But we need to wait for this thing to get up to at least $8 a share. Now, if I scroll down on my list, number 30 is Foot Locker. So it's not by far the best value company that we have, but based on its price to earnings ratio of 3.7 right now, it does pay a 5% dividend right now. Right now, it's at $31 a share. I think it's closer to $60 a share intrinsic value. So this number here is close to 2. That means this price could double before it becomes fairly valued, which you're seeing here. So let's look at Foot Locker to get above $40 a share, get close to $50 a share, and then we'll look at Foot Locker, and at that point, we'll have made a really good return on it. And last but not least, up at the top of my list, it's number 6, is Vista Outdoor. Price to earnings ratio of 3.6. They don't pay a dividend right now. And I think the company is worth over $100 a share, whereas the current price is only $30 per share. That is a value to price ratio of over 3 times. And that lands this company really high on our list. And so I'm going to be looking for Vista Outdoor to at least double. Let's see it get to $60 per share before we consider what we're going to do next. So that is the valuation that I've done on these companies. And again, I will do in-depth analysis on these companies individually in their own videos. So stay tuned and subscribe if you want to see those. Next, I'm going to show you the spreadsheet where I'm documenting and tracking every single purchase of stock, every single deposit into this $1 Million Challenge trading account. And here it is. Now I have 2 tables for this spreadsheet right now, and up at the top, just some basic information. And this thing is updating live. So if I refresh the data, of course, it will update the current price of the stock and the current balance of the account, which is based on the stocks I'm currently owning. Now, over on the right, I have a balance activity sheet. I have a balance activity table where it shows the stock gift bonuses that I got, which I sold immediately, the fees that it charges for each sale, which I guess is 2 cents on Moomoo, which is fine with me. I mean, if I'm buying at hundreds of dollars at a time and I only get charged 2 cents for commission or whatever you want to call it, that is pretty much negligible. But every time I deposit, so I did my initial $2,000 deposit, I'm going to mark it here, and we're going to see the balance of my portfolio and the cash available at all times. So I was awarded AMC stock at $28.68 a share, which I turned around and sold immediately, and DraftKings as well. I was awarded one share at $25.26, which I sold immediately. Again, fees for selling those. But most recently, I bought on August 9th, Hernium, Foot Locker, LND, VSTO, and I came back just to top off a little bit more on LND. So I'm very detailed in this table. Every single transaction is marked differently so that I can keep track everything that happened and exactly when. And this is something that I'm making available on this YouTube video just to be transparent about this $1 million journey. Now, these are the positions of the stocks that I own, and everything to the right of this thick dark line here is going to be showing times that I've sold stocks that I owned, and I have the closeout return, and I'm going to put a formula in here to show the annualized return. But since I haven't closed anything out yet, there's not really anything showing there. I did close out the stocks I was given for free, but because I sold them for the same price that were given to me, I just went ahead and zeroed out the cash outcome of those, and there is no return really. They just were treated basically as a separate deposit, which I didn't pay for. It was like a gift deposited for me. Now here at the top, I show the unrealized profit and loss and the realized profit and loss. Right now, again, there's no realized profit and loss. Everything I've sold has just been stuff that was given to me. But when I go to sell out of a position, that will show up in the realized profit and loss column here. And you can see these are the stocks that I own. Now, I have 2 separate positions of LND because I went back and bought a little bit more, 4 more shares a few minutes later, realizing that I still had some cash left. I am going to keep a little bit of cash available at all times just in case something comes up. And right now that cash on hand is really low, so I really couldn't buy much if I saw a good opportunity. But it's there just in case. And the higher this portfolio balance gets, the higher that residual cash available is going to be. I don't know if I'm ever going to use it. I'm going to try to keep my cash deployed pretty well at all times. So we'll just see how that fluctuates with how much cash I'm actually deploying. But you can see here that I put the date that I entered a position, what stock it was that I bought, and what price I bought it at, how many shares I bought, and that tells how much my cost basis was for each position. Then I have the current price in this column and the current value based on how many shares I own. And right here is calculating the current profit and loss, or the unrealized profit and loss as I'm holding these. When I come and sell these positions, I'll put the close date, the sell price, and it will calculate the cash outcome. And the time owned is going to be calculated in terms of number of days or whatever it may be, just so that I can calculate an annualized equivalent return for that position. So there you have it, guys. This is my account right now. Those are the 4 stocks that I own, and my current balance is $2,141. I'm going to put that balance on the thumbnail of every single video in this series that I do, so that you can see total transparency, the progress that we're making in our $1 million journey. Well, thank you so much for joining along for this first video. Again, I hope we become millionaires together over the next 10 years, and this is going to be really fun. Stay tuned for discounted cash flow analysis, how-to, individual stock valuations. If this video helped you at all, please give it a like and subscribe if you want to continue to follow along this journey. Thank you so much. Until next time, take care.